Hello and welcome to the very first episode of the Hardman Talk series, the Private Company Forum. I'm Richard Angus, Head of Business Development at Hardman & Co. And today we're going to be delving into the fascinating and complex world of private company valuations and discussing what's happening in the UK today. We're very fortunate to have so many entrepreneurs in this country, but the commercialization of their companies is often a challenge, especially when they require extra funding to pass the point of self-sufficiency. I'm thrilled to be joined today by two esteemed guests who bring a wealth of experience and insights to the table. First, we have Doug Lawson, CEO and founder of MarktoMarket. Doug, welcome and thank you for joining us. Doug will be talking to us a little later about the statistical trends and transaction values in the market. And from Saffery, we have Seb Cartwright, who is a partner and a member of their corporate finance team. And I will be interviewing Seb later and talking about the importance of due diligence and other factors in establishing valuations in today's challenging circumstances. But first, I'm going to start with a few general comments and suggestions about what we're seeing in terms of valuation dynamics and the amount of business that's coming into Hardman & Co. in the last 6 to 8 months, which has been significantly greater than before. So although our firm is best known for UK research, for about the last 8 years, we've been delving into the private company world and providing services and valuation services to a number of clients. But this has changed materially recently. And I think it shows that under the surface, there's a lot of pencil sharpening going on. People are looking at valuations. They might not be buying or selling something at the moment or investing, but they are thinking, how do I ascertain the current value of a business? Now, let's begin with a very obvious statement. The relationship between entrepreneurs and corporates on the one side and investors on the other side, much of the time they're in sync, but sometimes they're not. The ambitions of corporates and the investment returns expected from investors maybe cause dislocation at time, and we get what's called a valuation gap. At other times, both sides of the market see whatever they're trying to achieve in sync and in unison. So if we look at the small cap market in the UK at the moment on the listed side, you will see there's a lot of dislocation. Many companies believe their shares are worth a lot more than they're currently trading at, and many investors are reluctant to support that view. So this is ultimately bad news all round. And if it's happening in the public markets and the small cap end of the market, there's a likelihood it could be happening in the private sector market as well. So it would be unwise to assume that the private sector, for whatever reason, does not reflect generally what's happening in the public market. So it's basically down to most of the time to the issues we have in any market, which is there are buyers and sellers, there's sentiment, there's changes of opinion, and you have to really know where you stand in terms of your bargaining power. So if you were to look at the market before COVID, for example, when companies raised capital, either privately or publicly, there was often a feeling that obviously there would be more money available at some point when the ambitions of the companies were satisfied. Investors could see what was happening and money would be available to fund the next stage of growth. Now, the issue we have now is that that is not the case. So before COVID, many companies were priced for success. Investors were interested in fantastic new ideas. They believed that whatever they were being told would probably happen. And they probably looked over their shoulder and found out who else was investing in these companies. They themselves maybe didn't know a huge amount about these businesses, but they knew enough to make what they would deem to be a confident investment decision. Now, that's not really what's happening now. Investors have a completely different attitude and they're much more cautious. And the other thing is they're not generally in a rush to commit. This makes it very difficult for many small companies because they go to work every day. They consume capital every day. They have ambitions. And so we're in a position where we need to see how we can solve this misalignment. Now, one thing, as I said when I started talking, was that we do think under the surface there are there's a lot of work going on to ascertain what companies are worth. And we think that's a positive, because last year people really said, we're not really terribly bothered, because we're not terribly bothered about investing or buying anything else or possibly selling anything else. But definitely that activity is taking over. So now the pendulum has swung back in the favor of investors. And building on this, we think, therefore, there's another element needed in order to assess the value of a private company. So we call this room risk. So room stands quite simply for running out of money risk. Before you look at a company you want to invest in, you may want to hear the story, which is a wonderful story about great growth opportunities, but actually you want to make sure that this company is not essentially priced to fail, will run out of business, run out of money, and you will basically lose your investment. So the room risk, which we will talk about in another separate talk, is quite straightforward. Nobody can misunderstand what we're talking about. It's not a hidden item on a balance sheet. It's not a hidden item in a boardroom. Nobody can say they don't understand what we're talking about. But you do need to stress the financials. In essence, what you're doing, you're looking at a balance sheet and cash flow as opposed to just looking at a P&L story. And so that's where we think we are today. And I'm now going to hand over to Doug, and Doug is hopefully going to add some statistics and some information that surrounds the whole story at the moment. So, Doug, thank you very much.
Thanks very much, Richard, and thank you to you and the Harman team for inviting me onto this. And it is yes, it's a real pleasure. So thank you. I'd just like to share a few slides to help with what I'm going to talk about here. And the first slide that I'm showing here is what we call the MarktoMarket all cap sub £250 million index. Now, for those of you that don't know, MarktoMarket is a data platform. It's a data platform that services the needs, hopefully, of advisors and investors, typically in the SME market, or the lower mid-market, some people call it. And our data is used by customers such as Hardman and Saffery Champness, and it's used for one of the key use cases is valuing companies. So when our customers, whether they're advising or they're considering an investment in a company, they'll often refer to our data in order to form an opinion about what a company is worth. And what this index is that we're looking at the moment, this chart that we're looking at the moment, what this is the combination of all of the data on our platform, as well as submissions by our customers. So we're very fortunate in that a lot of our customers will submit data to us when they complete a transaction. So when they sell a business, they'll tell us what was paid for the asset, broadly speaking, and what the multiples paid for that asset, for that company were as well. And that allows us to create this index. So this index is based on mergers and acquisitions activity, business exits during each calendar year. We also produce this quarterly and half yearly. The half-year report for 2024 is out shortly, and we can maybe cover that in a future session. But just to set the scene, I felt that the 2023 study is probably a good starting point because it's very, very comprehensive. What we're looking at here, if you look at the chart, the bars, the white bars, the bars with the circles that have been filled in, that represents the average EBITDA multiple paid, the mean EBITDA multiple paid for companies under £250 million in each of those 5 years, from 2019 to 2023. And the hollow lollipops, if you like, are the median, represent the median multiples paid. Now, what you can see here, if we focus on the median multiples, what you can see here is that between 2019 and 2021, and actually if you go back prior to 2019, multiples across our universe as a whole were relatively static. So they were trending around this kind of sub 8 times EBITDA mark. What happened in 2022 is that we started to see multiples fall. So you can see that the median figure for 2022 as a whole was 7 times. And in 2023, that continued and fell quite aggressively to 6 times EBITDA. So if you look at the difference between 2023 and 2021, for example, it's really quite a material fall. Now, that coincided, if you look into the quarterly data, this fall started to happen really in the second quarter of 2022 and really coincides there's a strong correlation between interest rates and business valuation. And in general, the higher the interest rates, the lower the business valuation, because you're discounting back that future value at a higher discount rate. So if you were to overlay this with interest rate movements, then you'd find a reasonably strong correlation. Now, in terms of the nuances and the limitations of this kind of study, the sub £250 million businesses, that as a cohort, that's obviously a pretty broad church. So we think of it a bit like the FTSE All Cap Index. You've got all kinds of companies in there, lots of different sizes of companies. So it's really a bit of a guide as to how the market is moving, but actually to really understand what's going on in specific markets that are interesting to you, either of a specific size or a specific sector, you need to look under the bonnet a bit. So we can now have a wee look at our size indices. Okay, so what we're looking at now, what we were looking at before was what we called our all cap index. And we split that index up into size indices. And that's so that our users can see how valuations have been moving in different size categories. The size categories we have are nano cap, micro cap, small cap, mid cap, and large cap. Nano cap is the bucket, if you like, where we put deals that have been valued at less than £2.5 million. So any business sold for under £2.5 million that we collect the data for, it will go into the bucket that produces our nano cap index. Our next index is what we call micro cap. That's between £2.5 and £10 million business exits. Then small cap, £10 to £50 million, mid cap, 50 to 250, and large cap, 250 plus. You can see here a clear correlation between business size and the exit multiple. So by and large, all other things being equal, which of course they're not, but all other things being equal, the larger the business, the higher the multiple the buyer will pay for it. So that, if you remember from the previous slide, our all cap index in 2023 was produced a median multiple of 6 times, and you can see that here. And then the nano cap index is 4.1 times, micro cap 5.8, and so on. So you can see that clear growth in multiple as the size of businesses increase. Now, what about if we look at each of these different indices on a time series? So if we go forward to our nano cap index, we've seen a contraction in multiples in our nano cap index. So this is, remember, looking at our smallest deals, sub £2.5 million deal values. And this index, if you like, typically traded around 5 times EBITDA. But you can see over the last couple of years that started to decline. So in a way, that's kind of mirrored our all cap index in terms of the valuation declines. What's quite interesting actually is that it hasn't declined as much as our all cap index. And I think that maybe at this end of the market, there are less macro factors involved in pricing the deal and perhaps more micro factors. So at this end of the market, you will have predominantly small owner-managed businesses where the decision to sell may be less influenced by what's going on in terms of interest rates and inflation and these macro factors that affect the M&A markets at the larger end, and more to do with the individual circumstances of the business owner. Perhaps they're nearing retirement, or there's ill health and a lack of succession, and perhaps they're forced into a position where they have to sell their business. So maybe that's why there's a bit less correlation at this end of the market. Now, if we go to our microcap index, 2.5 to 10 million pound deals. A similar situation, I would say, to the nano cap. So still lots and lots of owner-managed businesses here, predominantly owner-managed businesses. Not many companies here owned by private equity. So similar dynamics to nano cap. I think micro factors affecting the decision to sell. Of course, the more macro issues, is this a good time to sell, will come into force. But again, because these are smaller owner-managed businesses, they may have less flexibility about determining exactly when they want to exit the business. So again, we've seen over the last couple of years quite a material decline in valuations in this bit of the market. The small cap index, 10 to 50 million pound deals, interestingly, has held up quite well. Now, again, another caveat with these data sets is that unlike a FTSE index, for example, where the constituents are broadly the same companies that you're comparing period on period, with a private markets index like the MarktoMarket indices, you're always at the mercy of the companies that are selling at any point in time. So you're going to have different constituent companies in different periods. And what that means is you could have, in general, in aggregate, a higher quality of business in one period versus another period. But what's quite interesting about this area of the market is that multiples have been relatively static. We saw a bit of a sell-off, or rather a contraction multiples in 2022 with interest rates, and then a bit of a bounce back in 2023. So an interesting dynamic in this part of the market. The mid-cap index, now this is the 50 to 250 million pound businesses, and this is really where you see a lot of private equity activity in the UK. And when you look into these different samples, how many of these businesses are private equity owned, once you get into our mid-cap index, you see the percentage of private equity owned businesses increase dramatically. Now, this is the index where we've seen the greatest contraction in multiples. And some people refer to, in times of uncertainty, that a kind of flight to quality, and often people talk about a flight to size as well. Quality they equate with size, where people want to be associated with, want to invest in larger businesses because there's the perceived safety of larger businesses. That hasn't happened here. So the decline in multiples in this area of the market, in the mid-cap area of the market, has been the greatest when looking across all indices. So that very private equity dominated 50 to 250 million pound market has seen the greatest contraction in multiples last year versus the previous year. And then there's the large cap index. So coming back to this point about kind of flight to quality, we see a bit more stability at this end. I think I would caution here that sample sizes become much smaller once you get above 250 million pound deal sizes. So I think you have to treat this index with an element of caution. We also look at sector indices. So just to quickly take you through a couple of our sectors. So we've profiled three sectors in this report. The first one is industrials and business support services. The second is consumer, and the third is technology, media, and telecoms. Now, you can see that industrial and business support services, the median EBITDA multiple in 2013 was 5.3. In consumer, it was 6.8 for median EBITDA multiples. And in technology, media, and telecoms, it was 9.6. So that really tells you something about the perceived quality of businesses in each of those categories. They are pretty broad categories. So industrials and business support services will have cleaning companies as well as engineering companies. Consumer will be branded goods as well as retail and leisure, and technology, media and telecoms will be software companies, as well as media agencies, internet companies, tech hardware, telecommunications, etc. But I think that most people would perceive the quality of earnings in that technology, media and telecoms sector as higher than consumer, for example, and probably industrials and business support services. This again, these charts will look familiar to you now. This is the last 5 years trend in the sectors. So industrials and business support services, a big sell down there. 2023 median multiple is 5.3 versus 6.6 the year before. Relatively stable in consumer, but actually consumer fell heavily. We noticed during COVID and lockdown. When obviously retail businesses took a big hit, traditional retail businesses took a big hit there, and it's been sort of trending broadly sideways since then. And then technology, media, and telecoms has come off its highs, its kind of COVID era highs, when a lot of these companies were very sought after, and has kind of a small up in 2023 versus 2022. So that's maybe a bit of a feel for the more mature end of the market in terms of business exits and multiples for business exits. We also produce these reports, which we can maybe cover on another occasion, which looks at the valuations of earlier stage companies that are raising capital. So I think I'll leave it there, Richard, and just take any questions that you might have.
Just a couple of quick questions. So the mid cap index, do you think that's basically largely the interest rates play a large part in the fact that the valuations are lower? Do you think that's a sensitive area, or do you think there's another reason?
No, I think that's probably it. So my view would be that this is obviously an area of the market. I've just flicked back to that slide now, which is very private equity dominated, and you would expect in most circumstances when private equity is buying an established profitable company that they would use, to some extent, leverage. They would use debt to do the acquisition. Now, if interest rates are higher, debt is more expensive. The amount of leverage that you'll be able to put into the deal will fall, and therefore the price of the transaction should fall, because you can't meet the same returns as you could if the leverage was higher. So I think that is very much a function. The fall in multiples at this end of the market is very much a function of the private equity dominance of this 50 to 250 million area, and private equity not being able to get hold of debt to the same extent that they were when interest rates were lower, and that is going to impact their returns and therefore the price that they're willing to pay on the way into a deal. And we've also heard more sort of anecdotally a lot of private equity deals being done over the last couple of years on an equity only basis. So instead of teeing up the equity from the fund and bank debt in order to complete the deal, funding the deal as 100% equity and then refinancing further down the line. So definitely the kind of leverage within the deals at this end of the market has been falling, and that's been hitting the pricing.
Okay, I think in the interest of time, I'm just going to ask you one very quick question, but I suspect it's going to be the subject of probably a whole separate Hartman Talks, and that is, if you have an early stage company that's not profitable or pre-revenue, how do you manage to value it? And do you think these companies are actually getting funded at the moment, or do you think basically they're disappearing before they have a chance to go anywhere?
Yeah, so I think we could talk about this for a long time, and I think Seb will have lots of views on this as well. What I would say is that maybe one of the traditional ways to do it, if you have no profits, obviously you can't apply an EBITDA multiple. If you have revenues, if they're established, you can look at market multiples, revenue multiples. If you have no revenues, then you have to do something else. Now, one of the mechanisms is to do a discounted cash flow, but they're highly subjective. And any of the inputs you can change. There are lots of subjective inputs, and small changes can make a very material difference to the valuation. I think another interesting way to benchmark early stage valuations, and this is what we try to do with our fundraising indices, is to benchmark pre-money valuations against similar companies. So if I have a pre-revenue SaaS product or biotech or whatever, show me a list of pre-revenue SaaS products or pre-revenue biotechs that are similar to me and the stage that I'm at with my business, and what valuation have they raised capital at. And I think that's just it doesn't give you the answer, but I think it gives you a very useful set of benchmarks for, okay, well, pre-seed SaaS companies in my area of the market are raising 1 to 2 million of capital at 4 to 5 million, typically 4 to 5 million pre-money valuation. I think that's a pretty valuable and useful benchmark to have and to use as part of your work in those situations. There's obviously the really straightforward one as well, which is where a company that is raising capital goes to the investor and says, I'm looking for £1 million. And the investor says, well, we take 20% at this stage. So if 1 million is 20%, then the pre-money is 4. You do the maths, the pre-money is 4 and the post-money is 5. But I still think it's pretty valuable to be able to point to benchmarks and say, well, that's undervaluing our business, because I can show you a whole bunch of deals for similar companies, similar fundraisings that were done at a at a premium to that. And really quickly, Richard, in terms of whether companies are getting funded, the volumes have fallen, but it's still happening. There's been a bit of pressure on valuation. I think with smaller company, the earlier stage companies, we've sometimes been a bit surprised about how robust that has been. And as I say, we'll have our latest indices coming out in the next couple of weeks. So we'll be able to show maybe in a future webinar podcast exactly how that market has been tracking.
Doug, thank you very much for that very interesting discussion. And now it's a great pleasure for me to ask Seb a few interesting questions about how he approaches valuations in such a tricky and difficult market. Seb, perhaps before we start, you could just say a couple of words about yourself and your firm, just to set the tone for the rest of our questions. Thank you very much indeed.
So I'm a corporate finance partner at Saffery. So Saffery is a national firm of accountants. I work in the corporate finance team, which at Saffery means a mixture of things. So I do primarily transaction services work, so working on the buy and sell side of transactions, which means that I'm at kind of the cutting edge of seeing what live valuations are in the market through what our clients are transacting at. But within my role, I'm also a valuation expert. So I carry out valuation expert witness work, some commercial style valuations, similar to what you noted earlier, Richard. And yeah, pleasingly, we're seeing similar trends that inquiries for that type of work's picking up, which we typically see as the canary in the coal mine for wider business activity, or at least that's what we're hoping it will be after a couple of years of slightly lower volumes.
So how do the valuation approaches differ across sectors? Have you got any sort of broad comments that you can give just to give us some sort of guidance?
Yeah, sure. So I think in an ideal world, and I'm sure, Richard, you may agree with this, in an ideal world, most valuation experts would like to go to some form of discounted cash flow valuation using perfect information going forwards into at least 5 years into the future. Now, in the space that we operate in, which is kind of owner-managed entrepreneurial style businesses, imperfect information is very rare. It's quite hard to come by, and when you do get it, you've probably seen many forecasts that look a bit like a hockey stick when you map them onto a graph. So not necessarily perfect information. So what most valuation experts end up doing more often than not is reverting to some form of benchmark evaluation. So as Doug's just set out there in the MarktoMarket data, a lot of experts for most commercial valuations will use some proxy of EBITDA, so a multiple of EBITDA, to get you to an enterprise value, and then you make equity value adjustments, so cash, debt, looking at working capital. Generally, most corporate sectors, I'd say that's still the trend, but there are specific sectors where different methodologies can be employed. So Doug's just covered there the difference between not necessarily sector specific, but early stage versus late stage, so pre-revenue, pre-profit, and then post-profit companies. That can lead to differences in methodologies, irrespective of sector. But there are certain sectors, such as with SaaS businesses, a lot of buyers are still looking at those on some form of revenue multiple, because again, it's recurring revenue models with consistent profits. The revenue can often be seen as that's the figure. There are certain other businesses like IFA style businesses or asset managers where people can actually look at assets under management and multiples of that, because again, if you're a trade buyer and you're looking to bring it under your own umbrella with your own fee structure, it's more relevant to look at what you're going to generate once those assets come under your umbrella than what it currently generates. And then there's certain artistic style businesses. So music catalogs are often valued based on things like net publisher share multiples. And there are certain large buyers in the market that publish what they're paying for those catalogs. And that can, again, be useful benchmarks. But again, just to build on what Doug was saying, what's really useful is having at least two methodologies for any valuation you do as a cross-check to make sure you're never really moving away from market on anything. And benchmarks are always useful.
So when you're coming to do due diligence, or when due diligence is required, presumably vendor due diligence can be very helpful to purchasers, because they feel that actually, rather than starting again, they've got an opportunity that's already essentially been pre-screened for them. Is that a fair statement, or does it require the purchaser to basically take responsibility for all due diligence?
So vendor due diligence, which, yeah, for the avoidance of doubt, is effectively where a seller, prior to going to market or during a process of going to market, commissions their own due diligence to be done. So typically full financial, tax and legal due diligence. It has benefits for both buyer and seller in that situation. So for a buyer, as you've just alluded to there, of course, you're coming into a transaction process, typically prior to bids being solicited, with the understanding that diligence has been conducted, the numbers that you're assessing have had thorough due diligence carried out on them, and it reduces that surprise factor that actually you're not receiving unreviewed numbers that you then have to make a bid off to then carry out your due diligence. And I think the reason why vendor due diligence is becoming increasingly popular is we're in a market at the moment where transactions are taking longer than they used to. More often than not, there are issues arising in diligence that are leading to either changes in valuation, negotiations around structuring of the transaction, or buyers just pulling out because of findings. So what it offers to sellers is that certainty that an expert's already assessed your numbers before you've gone to market. They've identified issues which you have either the opportunity to eradicate, mitigate, or at least form a view on how you might negotiate with a buyer, and you can go into a process with a lot more transparency. And I think that's the real benefit of vendor due diligence, and why we're seeing it more often is because in an environment where you've got a valuation gap already and you're going into a transaction where any finding in due diligence could jeopardize the transaction, having that due diligence gives you certainty that you can still get it over the line.
So there must be various reasons that transactions or valuations are requested. So they could be for sale, for investment, they could be for regulatory purposes. There are a number of reasons that you might be approached. How does that influence your approach and the valuation methodology?
So again, I suppose in an ideal world, whatever you're being asked to value, really you should be dictating your methodology based on the nature of the asset. So most valuation asks whether it's prior to someone investing, prior to someone seeking investment, prior to someone looking to sell, or someone looking to buy. In all those situations, what someone's trying to get to is, what is this thing worth in the market? So effectively like a fair value. So I'd say typically your methodology should be based on the nature of the asset rather than the nature of the ask. However, there are circumstances and situations in which you have a different methodology because of the ask. So more specifically, expert witness work, often if it's, for example, a shareholder dispute, the articles might prescribe a valuation methodology. And whilst as an expert, I might think, well, this asset suits a different methodology, legally, there is one way to do it because the articles tell you how, and you might use a different method there. I think with private equity and venture capital style investors, the way I see them often looking at valuation would be an initial discounted cash flow followed by some form of exit multiple at the back end. as compared to, say, a traditional theoretical valuation where you would use a discounted cash flow to the end of the forecast period and then a perpetuity assumption. And again, I think that's the nature of the holding period. So what private equity is often looking to do is they've got an investment holding period where they invest in, grow the business, and then they look to sell it on to the next buyer or IPO in the traditional markets. Obviously, capital markets have been quieter, but the reason they might look at valuation in this other way is because that's what they're effectively going to transact based on, will be a shorter holding period followed by an exit multiple. So again, you can see different methodologies there. And then the final type of work we do that can have very specific methodologies is around financial reporting. So there's a difference, for example, between looking at the fair value of something in the market as compared to its value and use in a company. And again, there can be specific methodologies applied there. But typically in commercial valuations, I would tend to expect that the valuation methodology is set based on the nature of the asset and the sector rather than necessarily the nature of the ask.
Right. So if you were giving advice to a business owner how to basically enhance the value of their company, what sort of general advice would you give if there wasn't an urgency in terms of a transaction being required? So you've got a year or two, you've got a great business, you want to grow the valuation. What sort of comments would you make to the average owner, and how much do you think they appreciate what you're telling them as new news, and how much do you think they already knew what you're telling them? Because I think there's a lot of misperceptions about how to value businesses with owners. So maybe can wrap that up into one answer.
Yeah, so to the second question, how much do they value what I'm telling them, you might have to ask them. But to the first question, which is, what would I advise? The most common advice, we have these conversations a lot. We've got a large client base, and there's often entrepreneurs within that client base thinking about some form of exit in the future, and they might want some indication of how would someone value it, and with that in mind, how do I make it more valuable? The first advice is always, for an entrepreneur, you've grown your business and it's a valuable business because of you and how you're growing it. So focus on growing your business as opposed to focusing and getting fixated on multiples, for example, or things outside of your control. So with most transactions working on some form of EBITDA multiple, still that's what we see. The best thing you can do as an owner is focus on growing your EBITDA. So clearly that is top line growth, but also managing your cost base. The multiple, generally speaking, I think owners have a slight misconception on how much control they have over that. The market's going to set your multiple once they get into diligence or once they get into review. And some people think, well, if I can get some technology into the business, I'll get a higher multiple because technology transacts at higher multiples. But a lot of businesses aren't tech businesses. They're tech enabled. And most businesses in today's age are tech enabled. So I don't think it's as big a differentiator as some people think. So the most common advice is to focus on your EBITDA and the growth story. People want to invest into growth. So if you can build out growth over a couple of years, if you can manage your cost base, if you can show that when revenues grow, profits grow because you manage margins well, those are really the best bits of advice I think that most owners can get. There are other areas around the fringes. So succession planning, making sure there's a second tier of management in place that are appropriately incentivized. They're harder to quantify, but clearly a buyer will value those. I can't necessarily put a pound value to it, but they're the types of things that you're trying to foresee issues in due diligence. But for me, it's mainly trying to get that equity story. Where's the growth and what's your underlying profitability and profit margin? That's the key focus for me.
So do you see the field of business valuations evolving over time? What do you think are going to be some trends that you might want to start looking at or thinking about if you were a business owner?
Sure. So first caveat, as I'm an accountant, I typically like to look backwards, but I think we are all in a world now where you have to try and project into what's going to happen. It's hard not to think about what the impact of AI might be into business valuations. There are plenty of softwares out there already that effectively are looking to be a one-stop shop, input some data, and then the algorithm will tell you what your business is worth. At the moment, I still think there's a lot of value to having expertise in valuation and to being plugged into the market and understanding what buyers and sellers are saying in transactions, which I think AI still has its limitations on, particularly in areas where live data is appropriate, because a lot of these models, large language models, have been built up on older data, most of it pre-COVID. And as Doug's just kindly shared with us, there are fairly stark differences between what the business environment looked like before 2020 and what it looks like today. But I think it would be slightly short-sighted of any expert to be completely disregarding the impact that automation and AI will have, because the speed of change is accelerating and it continues to do so. And I suspect that AI will speed up valuations. Whether or not it will change the fundamental nature of what things are worth, I don't know. I think clearly businesses that leverage AI might be worth more because they will become more profitable, but that's not the same thing as saying that the nature of valuation will change because of technology. I think high-tech businesses have always been worth more than old businesses. So if you think back 100 years, car companies were worth more than, they were at the cutting edge and they were the high-tech businesses. Now we're into an era where tech businesses are the most valuable in society. And I think it's just technological change impacts on what things are worth, but it doesn't change the underlying value, which I think, to your point earlier, Richard, is cash flow is still king. And it's another classic misconception, which is that profit equals cash flow. It really doesn't. And if you can have a business that is generating positive cash flows and positive profits, all the better, because that's the type of thing that diligence will find. So I think technology will change the way we do valuations, but it won't change the underlying nature of what the value of things is.
So, Seb, thank you very much indeed. I think we've probably run out of time. So, Seb and Doug, thank you very much indeed for your comments. You've got our series off to a tremendous start. So, to our viewers, I hope you've enjoyed the initial Hardman Talks on private companies. Please don't forget to subscribe and like, and hopefully we will see you on the next Hardman Talks very soon. Thank you very much indeed for joining us.